Hi, everyone. My name is Natalie. I'm the president of Women Who Invest.
I'm Grace. I'm the vice president.
And today, along with some of our education team members, we're going to be presenting about saving versus investing. Okay.
So we just have a little quote for you guys. Savings, remember, is the prerequisite of investment. So you can't invest if you don't save first.
Okay, so to kind of get started, saving is putting away income that you don't spend or for future use or need. And investing, on the other hand, is allocating money with the expectation of benefit or return in the future. Now, these are two different definitions, but what I would say is the main difference between them is that risk aspect in between. So, when you're looking at saving, you want that money and you want to make sure that it's safe and that you need it in the future, while investing can give you higher returns, but it is riskier and you are at risk of losing that money. So to start off, we can cover some different types of risk. You don't need to memorize these or anything, but they are good to know. Market risk is essentially the risk of having your money within the market. So it could be like market crashes, think of the pandemic, and other stuff that may affect the economy. Default risk relates to the quality of the investment. So essentially, your investment can go bad if the company goes under. Liquidity risk is taking it out and taking it of your investment. So when we're talking about that liquidity aspect, it just means how easy it is to take your money out. Concentration risk is thinking of all of your eggs in one basket rather than spreading out your investments. And mortality risk is a little bit dark. It just kind of means that you may not live to see the benefits of your investment.
Awesome. So now I'm going to talk about the importance of investing now. And it's great all of you are here because you're being really proactive with that. So first is time value of money. And this is the idea that like $1 today is worth more than $1 tomorrow. So basically it's just stating you want to invest sooner rather than later because you'll benefit more from that. And then the power of compounding is a really important concept to understand. And how I think of it is kind of like gambling. So say you are going gambling with $100 and you're risking that $100, but you end up making $10. Well, you now can make money on $110. So basically in the stock market, you make money off of the original values you put in and then the accumulations from the stock market. And just like gambling, it can go down, but the trend we do see is that it goes up, which is great for us. So this is a time value of money example with our friends Claire and Kate. So Claire on the left starts investing at age 25, and then Kate on the right and starts investing at age 45, and Claire is only investing $250 a month. And I feel like that's even a pretty high amount, especially for college students. So it might even be $20 for you. And Kate is investing double that at $500 a month. But as you can see, although Kate is investing double of Claire, because Claire started so early, the bounce that she has in her investment account at age 65 is more than $400 more than Claire. And you can see they invested the same amount of money too, but this just basically is an example of how beneficial it is to start early. And then here's kind of a graph to show the power of compounding. So you can see the lighter linear line on the bottom, just that represents the money you're putting in. So maybe $20 a month, $5 a month even. And then the kind of more jagged line on top shows your returns on top of that. So as you can see, if you were to just and put that money, you would be making far less than you are because of that compounding, that additional money that you're making because of your earnings on the additional or the original balance.
So for those math people, when you're thinking of that compound returns, you want to think of exponential growth. So it's building on top of each other.
Okay, so we're going to obviously be talking about saving and investing today, but we are starting with saving. We have one of our education team members talking today.
Hi, I'm Adeline, and I will be talking about when to save. As we talked about in our last meeting, inside of your budget, you should have money that you are saving and setting aside each month, um, because that can be very helpful to reach your goals of your saving. And some examples of these are an emergency fund, a new car, a new laptop, or to pay off college loans or pay for future vacations. And this can be a really exciting thing because when you finally get to spend the money on these goals that you have, that'll be a really good feeling and you'll be able to achieve that. It's also very nice to save money because it's more liquid than investing. And that was one of the vocab words that was mentioned. It just means that you can always touch that money if you ever need it in the future instead of investing where you might not be able to reach it. And then paying off debt, the first very important thing to know is to know all about your loan, what type it is, how much money you have on it, and what the interest is, and how much you'll owe in the future. It's helpful to pay off just small amounts, even when you're in college, because that will break down the principal amount for when you have to be paying on interest for when you graduate. And that type of loan that waits until you graduate to accrue interest are the subsidized loans, but unsubsidized loans start accruing interest immediately. So those are more important to pay off first, so that you don't have as much to pay off at the end.
The two different types of accounts, the best way to kind of explain this is using my own personal accounts. So I have two accounts within Chase. I have a checking account and I have a savings account. So when I'm looking at my checking account, that money, I can see all of my transactions that I've been doing recently. So I'm getting gas, I'm getting groceries, and it's declining and I'm putting money within it. So it's used more for day-to-day stuff. The bad part of a checking account is that it's typically no interest. You're just having that money to use on a daily basis. Rather than when you're looking at your savings account, that money is when you're going to put aside for the future. So they're less accessible. So you usually have a couple of withdrawals per month. And that's why you don't see all those different transactions like in your checking account. But you typically have a little bit of interest. So your money is growing slightly. And they also have a minimum balance that you cannot fall under in risk of a charge, which you typically don't have with a checking account. Alrighty, so now we're going to be talking a little bit about some common retirement accounts, which are a little bit more long-term than your checking accounts.
Your 401k, this account you have to have an employer for, and this isn't really like a part-time job or like internship. You have to have a benefits plan, so it's set up through your employer, and some employers even match contributions. So when you set up your benefits plan with the employer, you say, oh, I want, say like 3% taken out of my paycheck every month, and it automatically gets put into this account. And basically the employer match would be, they will match up to 3%. So you're contributing 3% and they're also contributing 3%, the same amount. So it's like basically like free money from your employer. This is a post-tax account. So you say you're making $50,000 a year, you put in $5,000 a year to your 401k account. You do not pay tax on that. When you file for that, you're only paying tax on your $45,000. The rest of your salary, you pay tax on that when you take the money out at retirement. So there's yearly limits on the contribution. I believe right now it is like 19,500, and then once you're 50, it increases just kind of because you're getting close to retirement. Don't really have to worry about that right now. And then there are penalties if you take the money out early of your 401k. Yeah, so once it's in there, kind of you don't want to take it out unless you have like some big emergency. Okay. And then
go ahead.
Do you have something to add?
Yes, 401ks are usually good when you think that the rates are going to be lower in the future than they are now.
Okay, so now we're going to talk about a Roth IRA, which is an individual retirement account. This is, you don't have to have an employer to set this up. I would say like some college students have it. It's nice because you can just open it through like a bank broker or robo-advisor. And this is a pre-tax account. So what this means is the money is taxed when you put it in to the account, which is nice because, you know, especially now, you know, we're in a low tax bracket. So we're paying a lot less taxes now than we will be in the future, just because, you know, I'm sure we'll be making more money in the future. So that's good for, you know, when you're not making as much money. There are also limits on the yearly contribution. It's much lower. I believe it's $6,000 right now, just because it is pre-tax, and they understand that people would put all their money in there and not in a 401k when you're young. And you can also use the money in this account to invest. So again, you can have a bank broker or someone else do that. And then there's no penalty if you take the money out early, which is really nice. Yeah, so I would say Roth accounts are like pretty beneficial when you're in a low tax bracket. Okay, so I really like this infographic here. It kind of shows how to maximize the benefits from these two accounts. So basically, once you have these two, I know it could be a few years off for some of you, but honestly, put this, you know, keep this in the back of your head, because I think it's very helpful. So what you want to do, what would be most beneficial is to, you know, contribute as much as your company matches. So if they are matching 3%, it would be recommended that you also match 3%, because you don't want to miss out on basically the free money that your employer is giving you. And then you want to max out your Roth, just because it's beneficial when you're young. And then however much money in addition to that you want to invest, you know, you'd have to go do that through your 401k because you've maxed out your Roth. But yeah. So now we are going to be covering investing, and Emily's going to talk for a little bit.
Hey guys, I'm Emily. I'm going to be talking about investing. So first, when to invest. Think about, do you have extra cash? Do you need this money in the near future? You don't want to, you know, be out of cash. And has all of your high interest debt been paid off? Think of like credit cards with this, and any other high interest debt that you may have. And then have you built an emergency fund that's for if you lose your job, if you need it for medical issues, any other types of emergencies, like helping out your family at all. So yeah. And then also when talking about investing, you kind of have to talk about how to, like, what types of investments you can make. So first we have bonds. I'm going to start off with an example just to make it seem a little easier. So let's say you purchase a 5% bond, or a bond with a 5% coupon rate from a company. The bond has a face value of $1,000, so you will receive $50 in interest payments per year, and that's just taking 1,000 times 5%. So corporate issuers usually make payments in 6-month installments. So in our case, you could receive $25 in January, and then another $25 in June. And it kind of just goes like that. And all these payment schedules can be seen in documents like bond certificate, indenture agreement, everything like that. And I would say that it can be thought of as an IOU between the tender and borrower, because it has all the details and everything about the payments that you have to make. It's used by companies, states, sovereign governments to finance projects and corporations. Finance projects and operations. And then, yeah, so I would say bonds are a little bit more riskier, or less riskier than a stock, my bad, because usually seniority provides an extra level of security for bondholders. So this is why corporate bonds are generally considered safer investments than stocks, because you have a little bit more security as longer you go with the bond. So yeah.
Awesome. I do want to add that a lot of bonds are also issued by the government, which is like the least
Yeah.
risky thing you can do. Okay, so Emily kind of talked about this, but I'm just going to reiterate a little bit because even as a finance major, I found this slightly confusing when we first learned about it. So there are two main ways that bonds can make you money. So the interest payments, basically, like Emily said, say you get a $5,000 bond, and it's paying you 4% annually. That means you're just getting $200 a year for basically loaning the government or whoever, a company, that money. So over those 10 years, you're making an extra $2,000. And then at the end of the year, or at the end of the 10 years, you get the $5,000 back as well. So the second way you can make money on a bond, this doesn't always happen, depends on the type of bond, interest rates, things like that, but is selling the bond for more than you paid. So sometimes you'll get maybe back like $5,200 back instead of just your $5,000. So sometimes you also make money that way.
Awesome. And then with stocks, a stock or equity is a security that represents the ownership of a fraction of a corporation, and entitles the owner of the stock to a portion of the corporation's assets and profits equal to how much stock they own. And units of stocks are called shares. There are two main types that are common and preferred. They're bought and sold predominantly on stock exchanges like New York Stock Exchange and NASDAQ. And then these corporations issue or sell stock to raise funds to operate their businesses. Throughout history, they have outperformed most other investments over the long run, though they are more risky. They give you more benefits. And the entire stock market averages 10% annual return. And yeah, so I know someone from my work, they recently talked to me about how they bought a stock in cannabis and they got a $200 return. So I think they invested $750 and then they sold it for $950. So she was kind of like disappointed because she like could have kept it in longer instead of selling it. So it just has to do with the risk, and if you want to keep your money in longer than usual. And then it's important to diversify your stock portfolio. Like Natalie said, never put all of your money in one stock or never put all of your eggs into one basket. You should diversify, whether you want to put more of your money into bonds or stocks. It depends on your budget and everything. And then also index funds are important too. I don't know if we have a slide on that. Oh, awesome. And so index funds are a portfolio constructed of multiple stocks or bonds to match the average return of a financial market. It's also known as an ETF or an exchange traded fund. And they're slightly different, but similar concept. And so
we're gonna need it like in the chair. We'll have to do it like a different day than like the main. But
Michelle, you're not on mute.
Awesome. So index funds are more of a category of stocks and bonds.
My stomach has been growling for hours, and I realized I like didn't have any protein.
You would think of like dog food companies as a category. And it also has less risk because you're just like putting it into a category. More famous index funds include Standard & Poor's 500 index fund, and then also Dow Jones index fund. And they're purchased like a regular stock or bonds, but includes shares or portions of shares of multiple stocks or bonds. So a lot low risk. So yeah.
Perfect. When you're thinking of these different sections that we talked about, I want to bring it back to risk. So bonds are typically seen as less risky. And then you have your index funds because they add that level of risk that shares have, but they also have that spread. So that's eliminating that one type of risk. And then stocks are a little bit more riskier. So when you're looking at those, they're seen as like kind of the highest because they have such a big fluctuation rate. And getting started, I know that we covered a lot today, but you want to take a look first at what your goals are and how willing you are to put your money into riskier things, or if you need to have that money kind of guaranteed but growing less. So you're looking at your goals, how much money you need to reach them, and your time horizon. So if you have a savings goal of more than 20 years away, you probably want to put your money in stocks because it although the market fluctuates over time, it grows, which we'll talk about at later in the actually next semester. And then you want to understand your investment options. So you're looking at stocks, bonds, index funds, other different types of investment options to pick which one is best to reach those goals, and open an investment account. It's actually really easy. It takes like 7 minutes. Although people tell you need a broker, you don't need a broker. You can do it on your own through online options like apps. We've listed some down below: Ellevest, Acorn, SoFi, Robinhood, but there's also different websites that you can do like Charles Schwab and Fidelity.
Awesome. So now we just have our resources and recommendations on the topics we talked about today. So obviously, if you're interested in any one of these, you can look more into them. But there's a book called The 5 Mistakes Every Investor Makes and How to Avoid Them. Just points out common mistakes, simple concepts. And then the Money Tree Investing podcast. Yahoo Finance is a great resource. You can look at the stock market on there. There's news articles. A lot of my finance classes use Yahoo Finance to find information on things. And then you have Investopedia, which is a website that very simply explains a lot of confusing concepts. Also in my finance classes, if I'm confused about something, a lot of times Investopedia kind of has the answers, displayed out easily. And they also have videos that go along with a lot of the concepts. So that's kind of nice having that resource as well. And then Motley Fool is kind of similar to Investopedia. And then you have Fidelity Investments, which has a strong reputation for its mutual funds. A lot of people use it for their investment accounts. But if you're interested in any of these, obviously we send out the PDF for our presentation.
And so thank you all for coming. We have an Instagram where we pretty much post about our upcoming workshops. We post a lot of different resources on there. So it's just MU_WWI, and you can, follow us, drop a like. You can follow us on the Hub. That's my main way of sending out the email if you don't already. So you should just look up Women Who Invest and request to be added, and we'll add you like within 24 hours.
Yeah, and this will be the last meeting of the semester, but next semester we're going to get deeper into some other things. Like we'll have a whole workshop on stocks and a whole one on bonds, I believe. And we also have some speakers. I know someone from Charles Schwab is going to come in and talk about budgeting and do kind of an activity in March. And then Natalie, do we have someone for February? I don't know.
Yeah, but I don't want to
some
announce
other
it just yet.
but so that's really exciting. So hopefully that will make it more interesting. I know sometimes this is a little lecture-y, but it'll be nice to have some different faces here talking about some different things.
And this semester, we really tried to kind of build financial literacy so that it's not as confusing when we're talking about those different types of investments next semester. So we're really going to dive deep into stocks, bonds, and alternatives, and we were just kind of introducing them in this lecture. So if you guys have any questions, you can drop them in the chat. But if not, thank you so much for coming. We really appreciate you guys, and have a great rest of your afternoon.
Yeah, we'll see you next semester.